Hello to everyone. Today I am here with Financial Management Part 2. If you are interested to have update videos on banking and finance related topic, please do subscribe my channel. The financial goal of the corporation. The primary financial goal is shareholders wealth maximization. This translates to maximize the stock price. Now, how stock prices are going to maximize. One is when you add back your profitability to your business in the shape of retained earning or the reserve. It maximizes your stock price. And on the other side, different news is positive news is related your organizational measures. It also maximizes the stock price in the market. Now, there are few questions. First is, do firm has any responsibility to this to society at large? Yes. Every firm has the responsibility to meet the need of the society and to have a fair margin against their product. Secondly, is stock price maximization good or bad for the society? Normally, stock prices maximization do not directly having the impact on the society because the if a business used to reinvest a major part of its profitability to grow its business, it may not have any direct impact on the society. Thirdly, should firm behave ethically? There is no compromise on the ethical practices. Every business should behave ethically. Next is stock price maximization the same as the profit maximization? Profit maximization no doubt plays its role. Definitely, if you invest a major part of your profit towards your business, it will maximize the stock price as well. Yeah, there are certain further clarification. No, despite a generally high correlation among the stock price, earning per share, and the cash flow. Thereafter, the current stock price rely upon the current earning as well as the future earning and the cash flow. Definitely, future earnings forecasting and the future cash flow directly transfer a message to the market that you are going to take certain positive measures for your business growth. It will definitely maximize the market price of your stock. Some actions may cause an increase in the earning and yet cause the stock price to decrease and vice versa. Yes, it is a part of the business and the message and it depends the way the message conveyed to the market. What is agency relation? An agency relationship arises when one or the more individuals called principals hire an other individual or the organization called an agent to perform some services and then delegate the decision-making authorities to the agent. We have an example that the relation between the banks and the customer. In case of a bank, the customer deposit their checks, and bank used to collect their check as agents, and the decision-making authorities remain with the banks. Thereafter, an agency relationship exists when a principal hire an agent to act on their behalf. Within a corporation, agency relationship exists between the shareholders and managers and shareholders and creditors. First of all, what's the agency relation between shareholders and managers? Managers are naturally inclined to act in their own best interest, but the following factors affect the managerial behavior. Managerial compensation plan, direct intervention by the shareholder, the threat of firing, the threat of takeover. So any type of the threat uh, definitely brings certain hurdles between the shareholders and management relation. Thereafter, shareholders versus creditors. Shareholders who managers could take action to maximize the stock price that are determined to creditors. In the long run, such actions will raise the cost of the debt and ultimately lower the stock price. So the managers are naturally inclined to act in their own best interest. So these type of the actions give the short-term benefit to the organization. In the long run, they may have its adverse effect in the shape of decreasing their stock prices, particularly market prices. Factors that affect the stock prices, projected cash flows to the shareholders. It can be positive if your projection shows the positive growth of the organization. Definitely stock price will increase, and if there are certain things that are negatively affecting the businesses, it will reduce the stock price. Time of the cash flow stream. If if it is for the near the closure of the year, then at that time it may have a positive effect on the organization, or depends on the time. Either you are moving towards the acquisition or merger, so such news is definitely affect the price of your stocks in the market. Riskiness of the cash flows. How risky your cash flows are, it has an impact on the price. News related to the organizational restructuring, yes, it has a major effect. Decision made by the financial management, first of all, investment decision, financing decision related the use of the debt financing, dividend policy decision. These all decisions definitely having a major effect on the stock prices. Thereafter, asset liability management. The reason managers should understand asset liability problem faced for the investing type of the financial asset, the type of investment strategies they employ, the depository institutions seek to generate the income by the spread between the return that they earn on the asset and the cost of their fund. We have the example of the financial institution. On one side, they have their asset in the shape of investment and loans, and on the other side, they borrow the funds in the shape of the deposits on a certain cost. The objective is to sell money from one for more than it costs to buy the money. Definitely, when on the return they are paying to depositor, they will definitely invest or lend on the higher price in order to enjoy the spread in the shape of profitability. Nature of liabilities. Liabilities of the financial institution, we mean the amount and the timing of the cash outlay. Outlay means what are going out of the business that must be made to satisfy the contractual terms of the obligations issue. The liabilities of any financial institution can be categorized according to four types. First type is both the amount and the time of the liabilities are known with the certainty. Second type is the amount of cash outlay is known, but the time of cash outlay is uncertain. Life of the insurance is one of the examples. Type 3, the timing of the cash outlay is known, but the amount is uncertain. Return is picked or linked with the uh, central bank discount rate or the policy rate, KIBOR or the LIBOR, etc. Fourth type is the numerous insurance product pension obligation that present uncertainty as to both the amount and the time of the cash claim, because these both, you can say to some extent, uh, insurance and pension obligation are against the individual. In case of the death of any person, who are entitled to have the claim against the insurance and against the pension. So in that case, both are uncertain. Thank you very much. See you again with the upcoming video related to financial management. Thank you very much.